What does it mean when crazy happens in the stock market? There are two terms that I want you to understand that help define a downward movement in the stock market, and that is correction and bear market. A correction is when the stock market falls by 10%. A bear market, what many people like to call a crash, is when you see the stock market fall by 20% or more. So correction 10%, bear market 20% or more. But this is where things get interesting. How many bear markets do you think that we saw in the stock market between 1957 to 2022? And more specifically, when I say stock market, I'm referring to the S&P 500, which is a group of the 500 largest companies in the stock market. Well, over these years, we saw 12 bear markets, meaning 12 stock market crashes. And for you money nerds, what that equates to is essentially one stock market crash or bear market every 5.5 years. What does that mean? Crazy happens. This is not something out of the ordinary. We know that we see stock market crashes. We know that we see stock market corrections because this happens more often than this. And so history, while it doesn't exactly repeat itself, it does rhyme. And if you understand that crazy happens, you can then understand how do you find the opportunity to make money when crazy happens, because the ironic part of this crazy happening is many people forget that crazy happens and they assume that markets will only go up. And this brings me to part 2, patience. Let's go back in time a little bit. Take a look at the stock chart. Let's assume that you bought the S&P 500 in the year 2000, right before the big dot-com bubble bursting. Well, if you held on, you would have made your money back by 2007. And then, of course, we saw the big recession in 2008, which meant you would have saw another major market crash. But again, if you would have held on, you would have been profitable again by 2012. We know crazy happens. We've established that. And that crazy creates opportunity, but that opportunity is only there for the people that actually understand patience, because that means that you have to be able to hold on to your investments through the craziness. And during that patience, you have to stay calm, because during that craziness, people panic, they freak out, they sell. When the stock market saw this minor correction over the last week, people panicked and they freaked out, even though it wasn't that big of a dip. And this is where you have to be able to cut through the noise and continue to stay calm, as many people are losing their minds. Which then brings me to number 3, which is now, how do you actually build wealth? Because you might be thinking, well, Jaspreet, if I bought before the crash in 2000 and then I held on to 2007 and markets crashed again, that doesn't really do me any good. I mean, I have to wait a decade before I actually make any money. But you got to remember, in order for that to work, that means that you only bought in the year 2000 before the crash, but you never purchased again. And what financially savvy people are doing, and the real wealthy are doing, is when they see those downturns, they use it as an opportunity to buy. You've heard the phrase, buy the dip. Like Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful. What that means, if the markets are going down, you could use it as an opportunity to purchase. So if we go back to this S&P 500 chart, let's assume that you buy in the 2000 peak. But then as markets go down, you continue buying. You buy here, 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 and here on the way down. Then as markets go up, you buy here, 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 and here. You buy them on the way up. Then as markets crash again, you buy here, 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 and here. Then as they go up, you continue buying. Well, what does that mean? Now as the markets have really grown, you see that opportunity for your money to really compound and grow, because you were able to use those downturns as an opportunity to purchase. Maybe even buy more. Maybe even buy more aggressively, because that's when stocks go on sale. So what that means is that dips, corrections, and market crashes are really only bad for 2 people. They're bad for the people that sell at the bottom because they panic and they freak out. And it's also bad for the people that buy only at the top. Because if you don't use those as an opportunity to buy even more, well, now you're paying top dollar, but then you don't take advantage of the discounts when they happen, and then you have to wait the longest period of time to see any return on your money. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.